the Coca-Cola company. Our group consists of Dee McGaw, James Dickinson, and Katie Easley. Coca-Cola was founded in 1886 by a pharmacist named John Pemberton. It's one of the biggest companies in the world. Right now, over 10,400 Cokes are consumed of every second of every day, and the formula is still very top secret. Only a handful of people in the world know it. So with that being said, and with Coke being one of the biggest brands in the world, we're fairly certain that Coke will continue to be a good audit client and that we will continue to audit them for years to come. A little bit more about Coke. It's in the soft drink industry, and really has even expanded in recent years to other beverages like Dasani and vitamin water and Powerade that aren't necessarily soft drinks. Their main competitors are Pepsi, Nestle, and Dr. Pepper Snapple. As far as the industry outlook, consumer lifestyles and tastes have changed a little bit. It used to be that Coke was very popular and people would drink it all the time, but lately more health conscious trends have hurt the soft drink industry as a whole. We're starting to see more healthy alternatives to soft drinks in the industry, stuff like we were talking about with Powerade and Dasani and vitamin water. Also, raw materials are increasing industry-wide and have become a major factor in new product lines. And product branding is becoming increasingly important. In a recent study, Coca-Cola was named the #1 brand and their most recognizable brand in the world. As you can see, the profitability has had a downward trend in each of the last 3 years, going from about almost $29 billion to closer to $28 billion. Operating expenses have all gone up, while our operating income has gone down considerably. Just about every facet, every expense has gone up while all of our income has been going down. The net income has had a steady downward decline as well, from $9.8 billion to $7.8 billion. And some recent developments in Coca-Cola's products. Just recently they have introduced Coca-Cola Life, which has 35% fewer calories. So this is appealing to the healthier trends that are going on in America and across the world right now. They announced that Minute Maid will also start to sell premium milk, so another product for Coke to add to help reduce the losses in the carbonated soft drink industry. And it also said that in October it would start cutting costs, and announced the timeline for selling its low-margin bottling industries.
Starting off on the control risk side, they have not cited any significant deficiencies nor material weaknesses thus far, so they're doing pretty well from a control aspect. Their internal control is effective in regards to the COSO framework. And to move on to inherent risk assessment. The inherent risk assessment is limited to the effectiveness of internal controls. Some of the factors that are influencing this is competition that you don't know about that could be inherently in there, as well as world economics, considering that they are an international company and that they deal with many bottling, everything, like all supply and demand worldwide. Misstatements associated with inherent risk may not be detected due to inherent limitations. In regards to setting materiality, we set it at 5% of income before tax for 2014. We did this because it's usually the rule of thumb for public companies. So income before tax in 2014 was $9,325,000,000. So materiality at 5% of that is $466 million. Roughly, and the tolerable out we set at 2.5% to 2.5% of the same income before tax, which is $233 million. overview of financial position, like flex analysis, we have noted that their cash had a significant decrease in cash equivalents, but their short-term investments in marketable securities also had significant increases. The totals for those is cash and cash equivalents, short-term investments, marketable securities increased by $1.4 billion. So this increase reflects the company's overall cash management strategy, and most of their majority of the consolidated cash and stuff is dealt in foreign subsidiaries, since they're an international company and they keep money in a lot of foreign places. Trade accounts receivable decreased net by 8%, primarily due to the write-off of accounts of receivables in their bottling distributor in Venezuela, which, if you can tell, there's a lot of they have a lot of bottling facilities all over the world, and that's a big factor in their business. Assets held for sale increased $679 million, and liabilities held for sale increased $58 million. Once again, it's due to their South African bottling operations, still bottling operations, and related investments. The assets held by the company's global energy drink business being classified as held for sale is what happened, and that's why those numbers are the way they are. Industry-specific audit risks. Of course, since they are a beverage industry, they're in the beverage industry, most of their assets, like the largest portion of their assets, is inventory on the balance sheet, and controls for inventory are needed to be applied to ensure that stated inventory amounts actually exist, as well as certain procedures need to be implemented to make sure that you separate duties, or segregation of duties is the main one. They have to make sure that the same people aren't authorizing sales and collecting money and reporting it and doing all the same stuff. They can't let that, or it'll completely, reduce the effectiveness of the control. As for earnings pressure and industry pressure, one of the biggest factors that influence companies to commit fraud and other bad habits and whatnot is pressure from the industry to compete. As you can see, their 5-year sales growth is 9.94%, as opposed to industry growth of 7.21%, so they're beating the industry pretty well right now. They're above the industry average, and their earnings per share growth is significantly higher than the industry growth as a whole. And when we were reading, we noticed that the industry growth has actually, for EPS, has been declining over the past year, or over the past few years, whereas Coca-Cola's growth has actually been increasing. So in our opinion, we don't believe management has any pressure to manipulate sales or earnings growth in order to compete, because it's unnecessary.
Thank you, Dee. All right, what Katie and I are going to do now is go over some common risks that you can find in Coca-Cola's 10K. These risks are usually used for investors to make more thorough and educated decisions on whether to invest in companies like Coca-Cola. The first risk that we identified were environmental risk. And when you drink a Coke, you don't usually know, you can't really usually taste like specific ingredients, but what was surprising to me that Coca-Cola's main ingredient is water, and supplies of water around the world, since Coca-Cola is an international company, really affects or can really affect Coca-Cola's revenue and profitability. So our management assertions we were using were, since Coke derives the majority of its revenue from international sales, it's very important for them to disclose international environmental factors that affect water supply in foreign markets that they do business in. Our procedure we were going to use was to inquire information from management pertaining to their water supply that they use in different countries. All right, so another risk that is very notable and relevant right now is customer preference changes. All throughout the United States right now, people are forming healthier habits, whether that's exercising
or cutting down on food or making healthy food choices. In Coca-Cola's case, obviously, Coca-Cola isn't the healthiest beverage, so these new customer preferences around the world to shift to more heavier or healthier drink choices is a very prevalent risk for the Coca-Cola company. So as people are switching to these healthier risks, Coca-Cola really needs to find different alternatives to compensate for the loss of revenue for their normal Coke sales. The assertion we used for this risk is we want to make sure that because there's a likelihood that revenues will decrease, we want to make sure that the revenues actually do exist. And the procedure, how we make sure the revenues actually exist, we vouch for their existence using source documents. Obviously, Coca-Cola is, like I said before, a huge international company. So various legal changes around the world greatly affect Coca-Cola's business in other countries. So our assertion is important to consult with Coca-Cola's legal counsel and just get an update on new tax regulations or penalties or fines that could hurt the company in other countries. And the procedure to do with this is actually the same thing. It's to meet, just to talk with the council and inquire information from them to validate the rights and obligations that we used for the assertion. Competition, obviously competition is a threat for most major companies. You would think that Coca-Cola really runs away with all the competition throughout the world, but they have major competitors such as Pepsi, Nestle, and Kraft. All of these companies and more companies compete with them on an international, regional, and a local basis. So competition is a very prevalent risk for the Coca-Cola company. Since the competition is so high in this industry, it is important to make sure, again, that revenues actually exist and they aren't manipulated to boost Coca-Cola's financial health. The procedure to do this is to trace up from source documents to determine completeness.
I'm going to continue talking about some of the risks that Coca-Cola faces. One of those being fluctuations in exchange rates. Last year, Coca-Cola dealt with over 70 currencies, and that's because they operate in over 200 countries worldwide. In their financial statements, they say that they may have material adverse effect on financial results, and it's adverse because there are the lesser developed countries that they operate in are more susceptible to extreme fluctuations. So it kind of gets difficult to account for so many different rates at one time. One of the important assertions regarding the exchange rate is valuation. They have to ensure that revenues, expenses, assets, liabilities, and equities are all valued at their correct amount on their financial statements. To ensure the valuation is correct, there are a few procedures. First, there is the physical inspection of assets. Then there is the inspection of relevant records and documents. You would also need to confirm the recorded transactions and recalculation. Those would kind of go together just to make sure that everything that you recorded that was not in US dollars, and stuff that you did record in US dollars, but the recalculation to make sure that you converted it correctly, and confirmation just to make sure that the internal controls are working correctly in all the other countries and not just the US. Make sure that it's working everywhere. The next assertion is existence, and this one is really important. With existence, you have to ensure that your revenue and expense transactions actually happened. You don't want to be overstating your revenue, and you also don't want to be overstating your expenses, because that is material. And then you couldn't issue an unqualified opinion. You also have to ensure that your assets, your liabilities, and your equity actually exist. The same thing, if they don't exist, then it's a lie, and you can't give a good, an unqualified opinion. So in order to ensure the existence, so you're not, lying or manipulating data for the stockholders, some procedures in place would be scanning the data to identify anything unusual. That would be, like stuff at the end of the year that may or may not have happened, maybe not at the right time either. Vouching to ensure transactions occurred, because that just kind of goes hand in hand with existence. It's kind of intuitive. Then we have, you need to confirm the recorded transactions, that they actually happen, that they actually exist, that they're stated correctly. And then that kind of goes along with inquiring information from third parties like customers and banks. They can verify the transactions, the amounts, just basically that they exist and they're recorded properly. The last assertion is completeness and cutoff. With this, it just is to ensure that all transactions actually happened in their respective period and in their correct amount, that they are completely stated. You can do this via reconciliation of bank statements, scanning for suspicious transactions at the end of the year. That would just kind of, that's kind of the period where people tend to either want to increase their revenues or push their revenues off to manipulate their financial statements and their net income. So you just need to go and verify that everything happened. And again, confirmations from third parties. Go and verify with the customers that they're sending you inventory. They're not doing it early to increase your revenues or anything like that. It's one procedure, tracing of transactions from when it first begins to its final place on the financial statements. This is very important with completeness and cutoff, because tracing, you go through the complete process of it. So the final procedure, and I'm going to talk about analytical procedures. They evaluate the relationships between data. So it just kind of ensures that you're exchanging your currencies at the correct amounts, that you're recording everything at the correct amounts, that even though you're operating in 200 countries, everything is working just as it should. So, all in all, these are the risks that Coke faces. I hope this has been